In this video, we're going to be performing a deep dive on Illinois Tool Works dividend safety. To begin, let's talk about Illinois Tool Works' business model. ITW is a diversified industrial manufacturer with a market capitalization of $23 billion. The company has 7 unique operating segments and generates more than half of its revenue from outside of the United States. ITW was founded in 1912 and currently trades on the New York Stock Exchange with a market capitalization of $43 billion. ITW is a well-known dividend stock because of its compelling track record of dividend growth. With 54 years of consecutive dividend increases, ITW is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. In fact, ITW's dividend history qualifies it to be a member of the Dividend Aristocrats more than twice over. With more than 5 decades of dividend increases, ITW is a member of the Dividend Kings, an even more exclusive group of stocks with 50-plus years of dividend increases. Looking ahead, ITW's high dividend yield has led some investors to question the safety of its future dividend payments. For the remainder of this video, we will discuss the company's current dividend safety from 4 perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss ITW's dividend safety in the context of the company's current earnings. When ITW announced its third quarter financial results on October 24th, the company reported that it generated $5.77 of earnings per share through the first 9 months of the fiscal year. For context, ITW paid $2.56 of common share dividends during the same time period for a dividend payout ratio of just 44%. Using earnings, ITW's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. With that in mind, we will now compare ITW's current dividend payment to its free cash flow. Through the first 9 months of fiscal 2018, ITW generated $1.7 billion of free cash flow. The company distributed $792 million of common share dividends during the same time period for a payout ratio of 46%. Using free cash flow, our conclusion is the same as when we used earnings to measure ITW's dividend safety. The company's dividend appears very safe for the foreseeable future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze ITW's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. ITW's performance during this time period is shown here. ITW performed surprisingly poorly during the last recession. Earnings declined by 43% over 2 fiscal years. With that said, the company's earnings continued to cover its dividend and it continued its multi-decade streak of dividend increases. Perhaps most importantly, ITW's dividend would still be covered by earnings if it experienced a similar 43% decline in earnings today. With all this in mind, we believe that ITW is unlikely to cut its dividend in any future economic downturns. The last angle that we will use to assess ITW's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before its free cash flow will no longer cover its dividend payment. Through the first 9 months of fiscal 2018, ITW generated $194 million of interest expense and had total debt of $7.4 billion. This implies a weighted average interest rate of 3.5%. The following image shows how changes to Illinois Tool Works' weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, ITW's weighted average interest rate would need to rise to above the 20% level before its dividend would no longer be covered by free cash flow. With that in mind, we believe that ITW's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on ITW's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.